Hello, I'm Bill Griffith of CNBC. On behalf of the Options Industry Council, I'd like to thank you for your interest in learning how to optimize your stock portfolio with options, certainly one of investing's most versatile tools. The Options Industry Council is pleased to provide investors like you with quality educational materials like this video and the seminars they conduct throughout the United States and in Canada. The Options Industry Council comprises the American Stock Exchange, the Chicago Board Options Exchange, the Pacific Exchange, the Philadelphia Stock Exchange, and the Options Clearing Corporation. Now, the objective of the Council is to help you become a better investor with a broader understanding of your investment choices. This videotape is divided into two sections that illustrate how investors like you can use options to better manage your stock portfolios. The initial presentation provides a foundation for options trading. This section covers options definitions, as well as fundamental investment strategies like buying a call, buying a put, and selling a covered call. This segment runs about 20 minutes. The second half of this tape delves into more sophisticated investment strategies, such as reducing the cost of stock purchases, locking in and protecting profits at little or no out-of-pocket cost, and using options to help reduce stock losses. This tape will introduce you to option strategies that can be used in conjunction with your stock holdings to meet your investment challenges and goals. You know, options provide flexibility unlike other investment vehicles and provide investment opportunities in bull markets, bear markets, or neutral markets. In short, options give you options that no other single investment vehicle can. The Options Industry Council also sponsors a series of free seminars ranging from basic to advanced, as well as workshops on option strategies. These seminars, taught by exchange instructors, cover the topics featured in this video as well as other topics in greater detail. Now, I urge you to call 1-800-444-4360 to learn more about this program and when the Options Industry Council will be presenting its free seminars in your area. Now, those of you who have already seen the original video presentation, The Options Tool, may wish to proceed to how to optimize your stock portfolio with options. However, it may be helpful to review the concepts and terms presented in the first presentation.
Now there's an investment tool that provides things bank accounts, CDs, mutual funds, and other investments can't provide. The tool is stock options. How can options help you fry up new profits or hammer down investment security? For the next few minutes, let the exchanges that make up the Options Industry Council show you how. By using options, you might hit your investment goals right on the head.
Stock options. They're one of the most versatile tools for realizing potential profits and for portfolio protection. But what are stock options? Who uses them? And how can you use them? Well, basically, an option gives you, the buyer or holder, the right but not the obligation to buy or sell a stock over a certain period of time. For this right, you pay an amount called the premium. Options fall into two broad categories. There's a call, which gives you, the holder, the right but not the obligation to buy a stock at a predetermined price until a specific expiration date. Then there's a put, which gives you, the holder, the right to sell a stock at a predetermined price until a specific expiration date. The predetermined price is called a strike price or exercise price. Who uses options? Both individual and institutional investors around the world use options. Today in the U.S., options are traded on more than 1,000 stocks, from blue chip issues of the nation's major corporations to middle capitalization high growth equities, representing virtually every industrial sector. Trading in stock options alone has grown from 1 million contracts in 1973 to 110 million contracts annually, representing the equivalent of 11 billion shares of stock. Options have proven to be a superior investment tool, offering flexibility, diversification, and control. Individual investors, as well as some of the world's largest institutions and pension plans, take advantage of opportunities offered by options. Like them, you may use options to increase return on stock investments, buy equities at prices lower than current market prices, sell stocks at predetermined prices, generate additional investment income, provide protection for stock holdings. In the case of both puts and calls, the most that an option buyer can lose is the amount paid for the option. Now, this video will only deal with option buying and the selling what are called covered options, where the risks are limited. Now, there are other types of option strategies that involve substantial risks, but these will not be discussed here. Options give you investment options and are a tool you may find useful whether you're conservative or highly aggressive. Right now, you're probably saying to yourself, options sound pretty good, but how can I use them? Let's look in on a seminar that's being held on options. You'll get to see investors just like yourself, asking the questions you would want answered.
Okay, let's talk exactly about what an option is. There are two types of options contracts, calls and puts. Listed stock options trade on a securities exchange and, like stocks, can be bought or sold during a regular trading day. Now, to explain a stock option, let's compare it to something that you're already familiar with, like purchasing a home. When a buyer and seller of a home agree on a price, the buyer can put down a non-refundable deposit, which locks in the sale price for an agreed-upon period of time, let's say 30 days. If at the end of those 30 days the buyer decides he still wants to buy the house, the deposit ensures that the buyer will pay no more than the agreed-upon price, even if the value of the house has increased. But if the value of the house has decreased, or for any other reason the buyer decides he does not want to buy the house, the buyer can call off the deal and forfeit only the deposit. That agreement is in many ways like a call option, which gives you as the buyer the right, but not the obligation, to buy stock during a certain period of time. If you exercise your right to buy the stock, the seller of the call is obligated to sell you that stock. By the way, I'm sure you know that a commission is charged any time a security is bought or sold, and with options also when an option is exercised. This will have an impact on your return, but for the sake of simplicity, I'll omit taxes and commissions on all of the examples that I'll be using today. Also remember that in all of the examples, the numbers are hypothetical and for illustration purposes only. Okay, say you pay $3 for an XYZ August 50 call. It's worthwhile to note here that one option contract normally represents 100 shares of stock. So you would pay $300. That's $3, or the premium, times 100 shares. XYZ is the stock. August is the month in which your call expires. And the $50 means the strike price, or $50 per share. So for $300, the premium, you have the right to purchase 100 shares of XYZ stock for $50 a share, anytime up to the specified expiration date in August. Consider the real estate example that we mentioned before. Like the buyer concluding that he wants to go ahead and purchase the house. If the stock were to trade above $50 during the life of the option, let's say $60, you, the call buyer, would still have the right to purchase the stock for $50 per share. If, however, the stock were to fall below $50 per share, you have no obligation to purchase, and you could allow your option to expire. The only thing you forfeit is your premium of $300. So, what have we covered so far? Well, we've covered the premium. That's the dollar cost of your option contract. We've covered strike prices. That's the price at which the stock can be bought with calls or sold with puts. And there's the option's expiration month. Ordinarily, options expire after the third Friday of each month, which is the last day the expiring options can be traded. Options are listed with as much as 3 years until expiration.
Let me ask a basic question. What are the reasons for buying a call?
There are two primary reasons. First, purchasing a call gives you leverage. And secondly, your risk is limited to the amount that you paid for the option. Let me explain what I mean. Options give you the ability to participate in the stock's price movement until the option expires with a relatively small investment on your part. Now remember, I said that I would not be including commissions and taxes in my examples. Paying these will have an impact on your actual return. Okay, if you purchase 100 shares of XYZ stock for $50 per share, you would pay $5,000. Now, if XYZ rose to $60 per share, you may be able to sell your stock for $6,000 and make a profit of $1,000 or 20%. But say you had purchased an XYZ August 50 call, which was trading at the time for $3, assuming that the call would have 3 months to go until expiration. Since each option contract represents 100 shares, how much would you pay for that option?
The premium would be $300.
Right. So, for only $300, you can participate for 3 months in the stock's price movement. If, as before, the stock rose to $60 at expiration, one way to take a profit is to exercise your option and purchase the stock for $50. So, how much would you make on the stock trade?
If I exercised my option and bought the stock for $50 and then sold it for $60, then that would be $10 a share or $1,000, right?
Correct. Now, remember that you paid a premium of $300 for your option. So what would your total profit be now?
I made $1,000 on the stock, but paid $300 for the option. So my profit would be $700 overall.
So, on a $300 investment, you made $700, or a 233% profit. Now that's leverage. Of course, leverage works both ways, and a call option can have a total or a large percentage loss in value if the stock falls. But the most that you can lose is the premium that you paid. It's helpful to look at what happens when a stock only rises to, say, $52 a share at expiration. You could still exercise your option and buy the stock for $50, and you could sell the XYZ you just bought for $52.
That means I'm making $200, but I still paid $300 for the premium.
That's right. So what would your total overall loss be on the transaction?
That would be a $100 loss. But if I had just bought the stock, I would have made $200.
For a call purchase to be profitable, the stock must rise enough in value to cover the premium plus transaction costs. But remember the second reason for buying options. The most you can lose when you buy an option is the premium that you pay. Let's look at an example again where you buy 100 shares of the stock itself. If instead of rising, the stock falls to $43, you would have a loss of $7 per share, or $700. Now, let's go back to our XYZ August 50 call. If XYZ was trading at expiration anywhere below $50, let's say at $43, what would you do?
I sure wouldn't use my option to buy the stock for $50 a share when it was trading for $43.
So, you would let your option expire and forfeit your premium of $300.
So there is some risk with options.
Yes, as you can see from this diagram. With stock ownership, while your potential profit is unlimited, your potential loss could be substantial. With the option purchase, you can participate in the potential profit, less the amount that you paid for the premium. But your potential loss is limited to the $300 premium you originally paid.
If I buy a call, do I always have to exercise my call before or at expiration?
The answer to that question is no. As I said before, options trade on an exchange. So you may be able to sell your call during trading hours in the exchange market prior to its expiration. Of course, you may be selling for more or less than you originally paid, depending on how the stock price has moved since you bought the call and how long until expiration. Your broker can tell you the price at which the option you wish to sell is trading to help you decide whether or not you want to sell.
Is there another type of option that provides benefits if a stock or the market is falling?
Yes, that's a put option. Put options are very similar to call options in that they also have expiration dates, strike prices, and premiums. But as the buyer of a put, you have the right to sell a stock at the strike price. Let's look at an example. If you buy a May 45 put, you pay the option premium and have the right to sell 100 shares of ZYX for $45 by exercising the option up to and including the third Friday in May. With the stock at 45, you purchase a ZYX May 45 put for a premium of $1. Prior to expiration, ZYX falls to $40, which would mean that your put had a value of approximately $5, representing the difference between the $45 strike price and the current stock level of $40. In this case, owning the put gives you the right to sell stock for $5 more than the market price. If the stock price were anywhere above $45 at expiration, your put would expire worthless, and you would lose the premium that you paid. But that premium is the most you could lose.
I've heard that puts can be used as protection. Would you please explain how this works?
Suppose you had purchased a stock for $40, and now it's trading at $65. You could simply sell the stock and take your profits, but then you would not benefit if the stock price rose further. Another choice would be to purchase a put. If you chose the $65 strike price, your gains on the stock would be reduced by the price paid for the put. But the put would enable you to sell the stock until the put expires for $65, no matter how far the stock price drops. Let's look at an example. You purchase 100 shares of ZYX stock for $40 a share, so you pay $4,000. If the stock rose to $65, you could sell it and make $2,500. If you wanted to hold the stock because you believed it could continue to move higher, but were concerned about short-term weakness, you could buy a May 65 put for, say, $2. The put gives you the right to sell your stock for $65 per share at any time through the third Friday in May. Prior to expiration, let's assume the price of ZYX falls to $55. The put option allows you to sell the stock at $65. The $200 premium you paid protected your $2,500 in stock appreciation. Your position is now up $2,300. The full appreciation less the cost of the put.
But what happens if the stock doesn't fall and rises up to, say, $75?
Any appreciation is reduced by the amount paid for the put, or $200 in this example. Again, it's important to remember that the most money you can lose as a buyer of puts or calls is the premium you originally paid. In this case, the cost of buying puts can be viewed as the cost of term insurance.
Can I sell the put options I bought before expiration?
As with calls, put options trade on an exchange, and you may be able to sell your put during trading hours in the exchange market prior to its expiration. Remember, though, if you bought the puts to protect a stock position, when you sell the puts, you no longer have that protection. Although many investors use puts to profit from a decline in the price of a stock, as we have seen, another effective use for puts is to protect stock holdings.
Are there other ways I can use options with the stocks I already own?
Besides using a put for protection, the holder of a stock can sell calls against the stock he owns. This is known as covered call writing. Remember, I previously discussed buying a call? The buyer or holder of a call has the right to purchase stock at the strike price. If the holder has the right to buy, the seller, sometimes called the writer of a call, has the obligation to sell that stock at the strike price anytime the holder wants to exercise the call. In return for agreeing to sell your stock at that price, you as the seller receive the premium. That agreement puts a limit on how much you can benefit from appreciation of the stock that you already own. You'll see that in this example. Let's say 6 months ago, you bought 100 shares of XYZ stock at $40 per share. The stock has moved up to $48. You think it may stay around $48 for a while, but you still like the stock over the long term. If you were to sell a call against the stock, you would generate income and thereby increase your return. Now let's look at a 4-month call on XYZ stock with a strike price of $50 and a premium of $3 or $300 per contract. By selling this call, you're agreeing to sell your 100 shares of stock at $50 per share, the strike price, in exchange for being paid $300. If at expiration the stock had remained below the strike price of $50, you as the writer would keep the premium, $300, and you will still own the stock. Once the option has expired, you are no longer obligated to sell your stock at $50. If the stock drops, you could still incur a loss in the stock position, but that loss is offset at least partly by the option premium that you took in. So your break-even on the stock has been reduced to $37. The original cost of $40 less the $3 premium. If the stock has risen to $50 or above by expiration, the buyer of the option would exercise his call and you would receive $50 for your stock. Plus, you would still have the $300 option premium. But remember, no matter how much higher the stock is above the strike price, you're obligated to sell your stock at $50 per share. But because you received a $3 premium for selling the call, it's comparable to selling your XYZ stock at $53 per share.
What if I change my mind after I've sold the call and no longer want to be obligated to sell my stock?
In that case, you would want to buy back the call that you sold. You would still own the stock and would no longer be obligated to sell the stock. But remember, the price that you paid to buy back the call may be more than the original premium that you received when the call was sold. This would mean a loss on the option transaction.
But why do people buy the calls I'm selling in the first place?
They may be more optimistic about the stock than you are, or they may simply have a different strategy with different objectives.
With all the strikes available, how do I know which one to sell?
The higher the call strike price, the less premium you will receive. But it's also less likely that you'll have to sell your stock. On the other hand, with a lower strike price, you receive more premium, providing greater downside protection. But the likelihood is greater that you'll have to sell because of exercise. Choosing which strike price depends on your outlook towards a stock. Often you'll end up selling a call with the lowest strike that's still above the price of the stock.
Will I still collect dividends if I sell calls against my stock?
Yes. As long as you own the stock on the ex-dividend date, you will continue to receive dividends.
What are the appropriate market conditions for covered call writing?
The best market scenario for the covered call writer is one where the market is trending moderately higher. If in such a market you continually sell calls against stocks you own, you will gain a greater consistency of return. In exchange for that consistency, you give up a chance to benefit if the stock makes a big upward move.
How does a call with a strike price?
As you can see, options give you plenty of options. You can use them to increase the income on your investments or to protect your stock holdings. But that's just the beginning. Learn as much as you can about options. Read the Understanding Stock Options brochure and the Options Disclosure document. These booklets also explain other option strategies and the risks associated with them. Look for options listings on the financial pages of most major newspapers. Ask your broker or investment counselor for some of the brochures or pamphlets and talk to him or her about options. Of course, options involve risk and are not for all investors. But to find out if options can play a role in your investment program, consult your broker. Your broker can provide the details of other option strategies available to you and can help you understand transaction costs, margin requirements, and other considerations before you decide to begin using options. And consult your tax advisor about how taxes affect the results of options transactions. Most important, your broker will provide the personal professional guidance that will help you make intelligent, informed decisions in the use of options. Options are an extremely useful investment tool and one to seriously consider if you want to hammer down investment security or pry up new profits. That's the options tool.
The previous segment defined call and put options and illustrated how options can provide leverage as well as protection. You also learned that your risk in option ownership is limited to the premium or price paid for the option. Some of the strategies discussed were buying calls and puts and covered call writing. That's a way to increase the yield on stocks that you already own and provide limited downside protection. Now, this next section focuses on several strategies that can be used in conjunction with your stock portfolio. These examples will leverage what you learned in the previous section and further explore the versatility of options and how options can help you to more fully manage and optimize your investment portfolio.
Welcome. Today we're going to discuss several strategies that highlight the versatility of options and how options can help to reduce the cost of purchasing stock, to lock in stock gains while managing the risk of stock ownership, and to revitalize an underperforming stock investment. For the sake of simplicity, I'll exclude commissions and taxes from the examples. Remember to consider them carefully when implementing any strategy. Have you ever wanted to buy stock for less than its current market price? To accomplish this goal, most people consider placing a good till cancel, or GTC, limit order. An option strategy, known as put selling, essentially accomplishes the same goal. Let's say you want to buy XYZ stock, which is trading at $55, but you want to pay less than the market price. You could put in a limit order to buy the stock at $50, or you could sell a 6-month put with a $50 strike price for $3. In 6 months, if the stock continues to be above $50, the option expires worthless, and you get to keep the full $3 premium. Unlike the GTC limit order, you receive income while waiting for the stock to drop in price. Let's compare the GTC limit order and the put selling strategy when the stock is trading anywhere below $50 at expiration. Both orders would accomplish the same thing, and you would now be long the stock. The difference between the two orders is the basis, or cost, of buying the stock. With the GTC limit order, you would have purchased the stock for the limit price, $50. However, with the put strategy, while you would have been obligated to buy the stock at the strike price, $50, the $3 premium you received would have made the cost of owning the stock $47. It should be noted, had you entered a GTC limit order and the stock price briefly fell to $50 and then rebounded, you would have probably become a stock owner at $50 and shared in the stock's gains. The put seller might not be assigned prior to expiration and therefore wouldn't participate in stock gains in this circumstance. Also, just as with the limit order, you can change your mind and buy back the put option you sold. This will cancel your obligation to buy the stock. However, depending on the market at the time, you may have to pay more for the option than you sold it for. And in the meantime, you have to pay margin on your short put position. To summarize, if by expiration the stock does not fall below the strike price, as the put seller, you will get to keep the premium. If your assessment of the stock has not changed, you may want to repeat this strategy and write another put. However, if the stock falls below the strike price, you may be assigned the stock. Don't forget, that assignment just means that you will now own the stock, your original intention. The nice part is that the premium you received for selling the put will lower the cost of owning the stock. After assignment, the consequence of the put-selling strategy is simply stock ownership. As you can see, this strategy is almost exactly the same as a limit order to buy stock, a strategy you probably use often, with the added advantage of being paid while you wait to become a stock owner. A put sale lowers your purchase price on a stock and generates income while you wait for the stock to decline in value. Short or uncovered option margin is not the same as long margin. There are minimum margin requirements set by the exchanges. However, your brokerage firm may have higher requirements. Be sure to discuss margin carefully with your broker. If you use good till cancel limit orders, consider put selling. It offers the same potential, but you receive income while waiting for the stock to decline in value. The objective of the next strategy is to lock in profits on a stock, which has risen dramatically, but also reduce the risk of stock ownership. How does it work? Consider that you bought stock XYZ at $50, and it's currently trading at $76, and you'd like to hold the stock for further appreciation, but you want to protect your profits. You may want to insure this position with a protective put, as discussed in the first part of this tape. However, protecting your stock with a $70 put has a high cost, like any insurance policy. You may want to consider an option strategy known as a collar or hedge wrap. For our example, it's late July and you want protection into February. You could buy the 6-month $70 put and sell the 6-month $80 call. At the prices shown, you would net a $2.50 credit. What has this position accomplished? The maximum risk was $76, the current value of the stock. Since you bought a put, you can sell the stock at $70 regardless of market conditions. At most, your stock risk is $6. However, with the $2.50 netted from the option position, that risk drops to $3.50. If the stock were paying a dividend, that could further reduce the market risk. We've discussed what happens if the stock drops below its current levels. But what if it remains above $70? If the stock is called away from us at $80, we have netted $82.50 on the stock. That's $80 plus the $2.50 from the total position. That is an additional $6.50 of profit potential on a $76 stock. you have maintained some upside potential while limiting the downside market risk. Should the stock remain between $70 and $80, you get to keep the $2.50 premium. This strategy can also be considered to defer stock profits to the following tax year. You should discuss this further with your broker and tax consultant. This strategy, known as a collar or hedge wrap, lowers the insurance cost compared to simply purchasing a put outright. It can be used to reduce market risk following a substantial increase in a stock's value. This approach can remove most of the downside risk while still allowing for some upside potential. Finally, let's turn to the disappointing performers in your portfolio. Have you ever bought a stock only to see it decline in value? If you feel that the stock will continue to decline, the best approach may be to liquidate the stock and move on. However, if you feel that the worst is over and that a moderate rally is possible, and you're looking to break even on your investment and move on, consider a stock repair strategy. For this strategy to be most successful, the stock price decline should be no more than 25%, and you need a moderate improvement in the stock. A stock repair strategy uses the leverage of stock options to help you break even as the stock's value increases. Suppose you own 500 shares of XYZ that you purchased at $50 per share. However, XYZ is now trading at $38. You could buy 5 $40 calls 6 months out at $3 and sell 10 $45 calls 6 months out at $1.50. How did I determine the number of calls to buy and sell? Well, you own 500 shares of stock, and the 5 $40 calls cover an additional 500 shares of stock. So the sale of 10 calls is completely covered by the combined stock and long call position. 5 times $300 is $1,500. This is my cost. And 10 times $150 is $1,500. This is how much I receive. Without commission considerations, this is called an even money spread. You get it done without incurring additional premium. Let's look at how this position performs. On this chart, we have the stock price at expiration for a range of different prices, the corresponding loss of the stock based on the stock's price, call values based solely on their intrinsic value at expiration, and the net position. If the stock is still at $38 6 months from now, when these options expire, we will show a $12 loss, the same as we have now. The options didn't help us, but they didn't hurt us either. If the stock price improves to $40, we're down $10 for the stock. The options still expire worthless. Still, they didn't hurt us. If the stock moves to $42, the $40 call option is now $2 in the money, representing a $2 profit for us. An $8 loss on the stock minus a $2 profit on the option means we're down only $6. At $44, we're down $6 on the stock, but we've got a $4 gain on the $40 call option, so we've lost only $2. At $45, we're down $5 on the stock, but we're up $5 on the $40 call option. So at $45, not at $50, we've reached break even on this position. For an 18% gain in the stock price, this option strategy has brought us back to break even, whereas it would have required a 32% improvement in the stock price to reach break even without options. We've reduced the break even point without adding any extra cost, except for commissions, and without adding any extra risk to the position. However, the downside occurs when the stock rises above $45. We are obligated to sell the stock at $45 and can no longer participate in stock gains above that point. Consider the stock repair strategy for your stocks, which have been underperforming but should rally soon. It's especially effective in situations when you don't want to invest additional cash or take on incremental risk, but rather to recoup your investment and move on. I think you'll agree after seeing these 3 examples that options have considerable versatility and can truly serve as an important adjunct in your stock investing. We've seen how to reduce the cost of purchasing stock, how to lock in stock gains while managing the risk of stock ownership, and how to revitalize an underperforming stock investment.
Excuse me, Jack, do you have a few minutes?
Oh, sure.
Is it okay to ask you a few more option questions?
Of course. Come on in. Have a seat. Okay.
I seem to remember hearing about some options that go out for 2 or more years. What do you know about these?
Okay. These are called LEAPs, or long-term equity anticipation securities. These puts and calls afford investors with long-term perspectives a similar opportunity to adjust stock portfolio risk as enjoyed by short-term options users.
So they're just like these other options, only they have longer lives, right?
Well, LEAPs do have a couple of important distinctions. First, they're listed with only January expirations. And second, they use different symbols than short-term options on the same underlying stock. And of course, because of the additional time until expiration, LEAPs premiums are more expensive. But otherwise, LEAPs can be used just like shorter-term options. Here's an example. Suppose you watch YZX climb to $125 over the past year. Let's say you like the stock and in fact believe it can double over the next 2 years. But the stock's been extremely volatile, often backtracking dramatically. And maybe you think $125 per share is a lot to pay for a stock. You can, of course, obtain leverage by purchasing calls going out 3, 6, or even as much as 9 months, as you know. Say, for example, you thought of buying a 3-month call with a $130 strike price for $5 per share. This call would break even at expiration if YZX were trading at $135, which means that if the stock's not at or above the break-even point at expiration, some or all of the purchase premium could be lost. Here, the call's out of the money because its strike price is above the stock's current price. In other words, it's not worth exercising currently if your desire is to acquire the stock as cheaply as possible. Now, let's suppose there are LEAPs available on YZX. By the way, LEAPs are not traded on every issue, only the most liquid and actively traded ones. Still, there are LEAPs on over 230 stocks currently traded. A 2.5-year YZX LEAPs call, struck at $130, could be bought on a $37 per share basis. Now, that's more expensive in total dollars, certainly, than the 3-month call. And that means you're risking more. But now you have a 10-fold increase in your potential time in the market. And you still have leverage, too. You've paid less than 30% of the stock's current price in premium. Compared with the 4% premium paid for only 3 months in the short-term call, the LEAPs call is a relative bargain on a cost-per-day basis. But option premiums don't move dollar for dollar with the price of the underlying stock. An option's delta reflects the degree by which an option's premium can be expected to change for a $1 change in the price of the underlying stock. Deltas range between 0 and 1. Now, an option's delta is dynamic. It changes constantly. But out-of-the-money options will have the lowest deltas, so their premiums move relatively little in response to changes in the price of the underlying stock. Buying out-of-the-money options can give you leverage, but in exchange, your position's more speculative. You can take a more conservative approach by buying an in-the-money LEAPs call. A call's in the money when its strike price is below the underlying stock's current price. By choosing a strike price that's 20% or more in the money, your LEAPs call can then effectively serve as the stock substitute. Of course, the call option, even a LEAPs call, is not common stock. LEAPs, like other options, offer no dividend or voting rights. And every option has a limited life, while stock can be held indefinitely. Still, there's more staying power in a LEAPs call than there is in shorter dated calls. Consider the YZX 2.5-year $100 LEAPs call selling for $52 per share. Being so far in the money, this call's premium should appreciate by about 80% of any rise in the underlying stock. In other words, if the underlying stock rises by $1 per share today, the Leap's call should gain about 80 cents per share. An in-the-money Leap's call, price-wise, can act much like the underlying stock if its delta is near 1. Keep in mind now, again, that delta can change as time passes and as the price of the underlying stock fluctuates. But you can see here how you can get a substantial portion of the upside potential of the underlying stock by expending, in this case, only about 42% of the stock's current price. And of course, you have staying power, 2.5 years in which to participate in any stock price appreciation that may occur. So you've got long-term staying power similar to that of a stockholder, but at a fraction of the stock's current cost, which means for a given amount of investment capital, more diversification can be obtained by using Leaps. And of course, diversification is one way to reduce the risk associated with stock investments. If you had thought about buying 100 shares of YZX, originally at $125, you would have made a $12,500 capital investment. But buying the in-the-money Leaps calls instead cost only about $5,200, leaving $7,300 of investment capital available. You could use that capital to buy Leaps calls on other stocks to spread the risk around. So now the capital that would have been invested in only one stock can instead be invested in 2 or more by means of Leaps calls purchases. If you felt that you didn't need additional diversification, you could take an even more conservative approach by investing the unexpended investment capital in a treasury note, maturing at the same time as your Leaps call expires, or in a money market account. That way, the principal of the treasury note or the money market account acts as a safety net for a portion of your capital, and you'll have interest income as well to further reduce risk. Quite possibly, this type of strategy could prove less risky than buying outright stock under certain circumstances.
Sounds good, but recently I've been writing calls on stock I already own for additional income. The premium on the Leaps call would seem to offer me more income potential. Could I write Leap calls instead of buying them?
Sure. In fact, writing covered Leaps calls instead of shorter dated calls can provide dramatically better returns in certain cases, as well as providing more risk protection. Suppose you bought 100 shares of YZX at $70. If the stock's risen to $125, you could sell your shares and realize a $55 per share profit. But, of course, you'd forego any future profit opportunity if the stock should subsequently rise. So, what if you felt bullish on YZX for the long term, but felt the stock had reached what you think is a temporary price plateau at $125? Then you might consider writing a 3-month $130 call at $5 per share. You'd be foregoing your $55 profit if you did that, but if YZX remained below the strike price at expiration, you'd retain both your stock and the call premium. The call premium can be considered to have lowered your cost basis for the stock. So now you've only got a $65 rather than a $70 basis. Another way of looking at this is to say you've lowered your break-even point from $70 to $65. On the other hand, if YZX should rise above the strike price at expiration, you could expect your stock to be called away. You'd receive $130 for your shares, but you'd also keep the $5 per share call premium. So you could say your effective sale price would really be $135 per share. Now, if you instead wrote a 2.5-year $130 Leaps call for $35 per share, you would first lower your break-even point and therefore your risk to only $35. And second, you'd boost your potential effective sale price to $165. Now, it's important to keep in mind that writing calls on stock you own, whether short-term options or Leaps, forces you to give up the open-ended profit potential of the long stock position in a rallying market. Well, I'm sure you can see that by using Leaps calls instead of shorter dated calls, you dramatically widen the profitability range for your covered right. This would be especially valuable if the underlying stock is volatile. Of course, there's a whole lot more you can do with LEAPs besides these two strategies, but you get the idea. In fact, here's some educational software that the Options Industry Council is giving away to new seminar attendees that explains how LEAPs and other options work. Why don't you check it out?
Great.
Thanks, Jack. This will really be helpful.
Well, I'm glad you think so.
As you can certainly now appreciate, options are an extraordinarily versatile investment tool which provide numerous alternatives for optimizing your stock portfolio. In review, this video provided a foundation for options trading and covered strategies including participating in market movement through call and put purchases, increasing the yield on stocks you already own while receiving limited downside protection, insuring stocks against market risk, buying stock below current market price, locking in and protecting profits at little or no cost, and using options to help recover stock losses. As you saw, options will work well in conjunction with your stock portfolio and help you to optimize your investments. You can learn more about these and many other option strategies at an Options Industry Council seminar near you. The OIC offers basic and advanced seminars as well as a practical applications workshop. Please call 1-800-444-4360 to learn more about these interactive seminars and to register for one in your area. Learn as much as you can about options by reading Understanding Stock Options and the characteristics and risks of standardized options, which are included with this video. Options involve risk and are not suitable for everyone. But to learn if options can help you better manage your stock portfolio, consult your broker. Your broker can explain transaction costs, margin requirements, and other considerations which impact options investments. And consult your tax advisor about how taxes affect the results of options transactions. In the meantime, should you need additional information on options, please call any of the Options Industry Council exchanges which are listed on your screen. On behalf of the Options Industry Council, I'm Bill Griffith from CNBC. Thank you for your interest in options as an investment tool.
For information about equity options, visit the OIC homepage at www.optioncentral.com. The Options Industry Council is pleased to provide a variety of resources and educational materials on equity options available on the Internet's World Wide Web. Here are a few highlights of OIC's Options Central. The site allows visitors to directly access the websites of the 4 U.S. exchanges that list stock options: the American Stock Exchange, the Chicago Board Options Exchange, the Philadelphia Stock Exchange, the Pacific Stock Exchange, and the Options Clearing Corporation. 15-minute delay equity options and stock price information is provided by S&P Comstock via MarketQuote. An up-to-date search mechanism is available for all listed stock options, and LEAPS searches may be conducted by name or symbol. You can view daily, weekly, and monthly charts on stocks. You can view and download the Blueprint newsletter. Fill in the mailing information to receive subsequent issues of this free publication. Visit the Options Industry Council on the web at www.optioncentral.com.